In this video, I'm going to talk about what a draw on liquidity is. But before we get into the video, if you'd like to engage with other traders, you can join my Discord. Link in the description is totally free. So now, what is a draw on liquidity? So a draw on liquidity is where price is most likely to go. So now, how do we know where price is most likely to go? We have to define or build up a bias. So right here we see price has taken out sell side liquidity, and that means there's people that have their stop loss. So there's people that are going to have sell stops below these lows. And we see price comes down and take out the sell side liquidity, also touching a fairly gap. So then we could anticipate higher prices. And we see price makes a inversion value gap, which is also a confirmation that price is willing to go higher, and it also created a value gap. So that means it created a balanced price range, which is another confirmation for higher prices. So already we have free confirmation that price is probably going to be willing to go higher. So our draw on liquidity would be buy side liquidity or buy stops. So we see price makes a retracement down into this inversion value gap within the value gap, leaving these equal highs up here. So this would most likely be where price is going to go. So this is our draw on liquidity. So now we would anticipate a reaction off of this inversion value gap. And if you were to take a trade entry based off this idea of higher prices, you can go into a lower time frame and look for a trade entry. And for this example, we could enter this inversion value gap. So then we could enter when price made this retracement down to it and put our stop loss where we think price is most likely not to go. And that could be this low down here, which is a decently strict stop loss. And then we would target these equal highs. And in this case, we could maybe take partials at this internal range liquidity high or at this high and finally at this high up here. So now let's just go with this high. And if this trade were to succeed, we would make a 4 risk reward ratio. So now let's see if price can manage to go all the way up to these equal highs up here. And right here we see price respects the inversion value gap and goes all the way up to the first high. So now we want to see price going up to this high up here. And that price do right here. So if you were to go up to the higher time frame, you can see how price delivered all the way up to these equal highs or highs, and that was our draw on liquidity. So for this example, we're going to talk about why equal highs is a great draw on liquidity. And the reason equal highs, as we have right here, is a great draw on liquidity is because retail traders think there's a lot of resistance at these equal highs. So then, now that we know that the market is made to take out buy stops and sell stops, or sell side liquidity and buy side liquidity, and there's most likely going to be sell stops above these highs, as retail traders think there's resistance. So this is our draw on liquidity, as the market is made to draw up and take out these highs. We can look for a bullish trade. And first of all, we see price right here takes out this low. And we also create a balanced price range. As you see, we have a inversion value gap that gets inversed, and we also have a value gap. So now this right here would most likely, let's just say right here, this would be our trade entry. So let's say we were to enter right when price touches the inversion value gap just to be safe, and put our stop loss below this low, and then we would target the equal highs. And as you see, price starts to expand higher and goes all the way up and takes out the equal highs. And as you see, we also had a lot more highs up here. Which price also managed to take out. So that's why equal highs is a great draw on liquidity. We also have to be careful and look for equal highs and equal lows when we take a trade entry, because if in this case we were to take a trade entry when we saw we had, or we were to take a short and we saw we had equal highs above, we would most likely be stopped out. So, for example, let's say we were to take a trade entry at this inversion failure gap and put our stop loss at these equal highs and then target these lows down here. And the reason this trade wouldn't have worked is because the draw on liquidity is at these equal highs. So that's why we have to be careful when shorting when we have equal highs above. We also have to be careful making intermediate term highs and intermediate term lows to draw on liquidity, as these highs and lows are not made to be taken out before the order flow has shifted. So a classic intermediate term low and intermediate term high formation is first of all a short term low, and then a lower low below that short term low, and then a short term low again. And the lowest low is the intermediate term low, and these lows and highs are not made to be taken out before we have shifted the order flow. So a bullish example or bearish would look something like this, where we have a short-term high, then we have a higher high taking out that short-term high, and then we have a short-term high again. And this high up here will be the intermediate term high. So as we see, price has not shifted the order flow yet, and the draw on liquidity would most likely be at these highs up here. So then we would not take a short right here. So let's say we were to take a short when price closed below this failure gap, creating an inversion failure gap, put our stop loss at an invalidation, and then target these intermediate term lows. Wait. And target these intermediate term lows and put our stop loss right there. This, of course, will make a great risk reward ratio, but price wouldn't take out these intermediate term lows as the order flow has not shifted and the draw on liquidity is still higher. So for next example, we see price came down right here and respected this hourly failure gap. So we are delivering from an hourly failure gap, which is a higher time frame pre. And up here we have equal highs, so this would be the draw on liquidity. So now we can go into the lower time frame. Let's just go to the 15-minute and see we have this order block right here. And see price closed above this order block, made a retracement, closing within the order block, and not managing to close below it. So in this case, if you were to take a trade entry, you could enter right when we touch the order block, put your stop loss at the low of the order block, and target these equal highs. But this probably wouldn't be my main priority as a trade entry. So in that case, I would probably go into lower time frame, maybe the 5-minute. But let's just go down into the 1-minute. So right here we see price has formed a inversion failure gap. So this would probably be my go-to trade entry, as we had touched a higher time frame PDRA and we have a inversion failure gap, which, as we see, price came down, made a retracement, and I wouldn't take a trade entry at this inversion failure gap at a close above it. So basically what I'm saying is I wouldn't take a trade entry at the right when we touch above or close above the inversion failure gap, and I would have to wait for a retracement, as if I were to take a trade entry up here, I would have to have a very long stop loss. In my opinion, I want to have a more strict stop loss, so then I'll wait for a retracement, and as we see, this failure gap also get inversed, so now there aren't more failure gaps to be inversed. So in that case, I would take a trade entry at this inversion failure gap. So then I would enter right here, and I would probably put my stop loss down at this low, and then target the equal highs we have up here. So let's see if price could be able to go up to these equal highs. Let me just speed this up a bit. And at last we see price goes all the way up and takes out the equal highs, and this all happened in the New York session. So as we see, equal highs is a very strong draw on liquidity, and as I like, we have the inversion model as price touches a high time frame P array and makes an inversion further gap in the meantime. Some of you guys may have noticed that in this trade entry we had equal lows below. As you see, we had this low right here and this low right here. So why would I take this trade entry? And the reason for that is because we created a SMT, as you see. So whenever we create SMT and we still have equal lows down here, we could still anticipate higher prices. So for last example, we see we have equal lows down here as these lows are matching up. So then we see on the buy side of the curve, we created these equal lows, and now on the sell side of the curve, we could anticipate these equal lows to be taken out. So in this case, let me just zoom in. If we were to take a trade entry, we could enter right when we touch this further gap right here, as we made a small retracement and put our stop loss at this small swing high up here, and then target these equal lows down here. And that will make a 4.6 risk reward ratio. Also, if you were to go up to the higher time frame, you can see we created the inversion failure gap before the retracement we created. So now let's go down into lower time frame again. And see, this is where we had our trade entry. So you see, we created the inversion failure gap on the higher time frame, then we created the retracement, and then targeted the equal lows. So that was it for this video, and I hope you liked it. And if you did, please consider liking and subscribing. And if you have any questions or if there's any ICT concept that you want to learn more about, just comment down below. And as I said in the start of the video, if you'd like to engage with other traders, you can join my Discord. Link in the description is totally free.